The average millionaire has 7 streams of income. So the question is, are you 6 short? Let's talk about it. Welcome back, ladies and gentlemen, to the Banking Bros Podcast, where we simplify complex financial strategies and provide you with practical insights for your journey to financial success. Yeah. I'm Jay Do.
And I'm Jonah. And today we are diving into one of the most important concepts in investing. There's actually, it's diversification. That's the topic of today's episode. So we're going to break it down and show you how to spread your investments across maybe different asset classes so you can reduce risk and maximize your potential returns. And what I was going to say is I've got a pretty hot take on diversification.
We're ready.
Save it
I am too. Like, I've got one as well. So I'm going to start off with mine. So in this episode, it doesn't matter if you're starting at the beginning, you've got one job, J-O-B, and they're trying to get you to jump over backwards, or they're keeping you just over broke. How in the world do you invest or diversify for the long haul and for the big bucks?
You got one more for J-O-B. I wasn't ready with my sound effects. I got some laughs for you this time.
We've got just over broke, jump over backwards, and gotcha. And jocking over bank accounts.
No, that ain't it. All right. I'm ready for your hot take, though. I'm going to give mine as we talk through some of the things. So, again, diversifying your investment portfolio is widespread out there. That's like if you're into investments, if you're into strategy for growing your wealth, this is like a foundational, fundamental thing. You manage risk by diversifying. So the opposite of this is putting all your eggs in one basket, or saying, I believe in Walmart so much that I'm going to invest only in Walmart.
I believe in Walmart. You see, everybody's in there.
And then you rise and fall with the tides of Walmart. So instead of doing that, you diversify. So you spread your money, you spread your investments around. And a lot of people don't realize that what you really need to do is spread them around over different asset classes. So things like stocks and bonds and alternative investments and cash equivalents and things like that. And that's what we're going to talk about in this episode. But I do have a hot take.
I'm going to start with mine right here. And it is the idea that I started with at the top of the show. And it's that the average millionaire has 7 streams of income. Now, if you're going to go down that rabbit hole, so many people have their awakening in Robert Kiyosaki's Rich Dad series.
Yep.
And they hear things like the average millionaire has 7 streams of income. So what they attempt to do is diversify their efforts too early and too quickly. And here's my hot take. Ladies and gentlemen, you need to learn how to make, let's call it, $1 million in one area, and then you diversify investments. You don't actually go out there and get 7 jobs. You do not try 7 things at the same time.
So actually, believe it or not, that was part of my hot take. It's very similar to yours. I was going to say the same. People diversify too early. You diversify once you have money.
Once you have it.
Yeah, you don't diversify before you have it. In fact, some of the most popular people out there that you've heard of, that you like, that you use their sites and their programs, they focused is what they did. They went all in on one thing. Absolutely one. Everything else got cut out. They went all in on one thing. Then they made it big. And now you read about them owning the island and making the video and doing the movie and
selling the books and the courses.
Selling the books and the courses. 100%. But they didn't. That's not where they started.
Yeah. So think about somebody. We like basketball.
Sure.
And just a couple of weeks ago, we were able to see the Lakers at the Pacers.
I don't have any basketball sounds, but I have this one, which is technically a rim shot.
Well, yeah, I know what that is.
Yeah, well, I mean, it's the best I had.
Oh, got it. Rim shot. I was like, what are you talking about? It's a rim shot.
For basketball.
Oh, basketball. Yeah. Gotcha. Okay, so let's think about LeBron James. Love him or hate him, that's not the point. The point is, did he first get good at one thing before he started to be in Space Jam and before he started to get into the other investment, whatever he does. I don't even know what he's into. I don't watch enough TV to know what his investment portfolio.
I think the big thing
Schools,
recently
education.
is his school, his I Promise school, or maybe schools now. And then he's a minority owner in Liverpool.
Oh, that's right.
Club.
So he's got a piece of the Red Sox. He's got a piece of the Liverpool.
But again, the big part that we're talking about here is that he didn't start there. In fact, he couldn't have started there. He had to go make his money doing one thing in order to then open the doors for the other things.
Right.
So now, of course, he's I think the first billionaire to be still playing.
Yes,
basketball.
First billionaire athlete to still be in the game.
Now, if you read about him, he's very diversified. That's not where he was 10 years ago, 20 years ago, 30 years ago when he started playing at all.
Well, you have not 10 years ago because this man is old.
Well, he's
still in the game.
39.
He's 40.
40.
He's 40. So he's the same age as me, but he's December 30th.
He got a little more dollars.
Yeah. Hey, do we make the same amount of, ladies and gentlemen, speaking of diversification,
I'm just saying.
We all make the same amount of money, but Taylor Swift and LeBron James have figured out how to make it way faster. I can make the same amount. I do make the same amount of money as them. I just have to live to 900 years old.
Yeah.
Think about that.
Way faster.
Think about that. I was on a call just yesterday with a guy doing a cash consultation who was asking questions like this. Let's understand asset classes here. First, out of 4 is going to be stocks or equities. How to get a piece of the puzzle in a business. Yep. Number 2 is bonds. Number 3 is cash and cash equivalents. Yep. That's the one we talk about most often.
So these are liquid assets,
liquid
savings
assets,
accounts, money markets, the infinite banking concept.
Let's go. And then alternative investments, and we also talk about that quite a bit. And we're involved in some of those. So first off, let's talk about stocks, Jonah. We tend to err on the side of risk when we're talking about getting involved in companies' portfolios that you cannot control.
That's right.
So how do you feel about stocks, and what do the people need to know about this asset class?
They're not my favorite thing to use as far as an asset class. This is an asset class that, generally speaking, I'm going to avoid personally. But the widespread information out there is people like it. People don't want to avoid it. People follow it, right? This last week, we're recording this in the middle of April of 2025. So in this last week, the stock market has gone up, down, left, and right. It has literally been as wild as it could be. I literally saw some reports that said hasn't dropped that fast since the start of World War II, hasn't risen that fast since, I forget what it was, since 2008 or something. It was some crazy numbers. And the reason for all that is because there was a political policy that was in place, these tariffs, and then out of nowhere, it seemed for the average American, it went away for 90 days, or we're going to put it on hold. So the president wants to do or say something in the Oval Office, and then your dollars literally just start jumping up and down, left and right because of something that someone said. That's not an asset class that I prefer.
Right.
Not me, but a lot of people do. Right?
They do. And one of the reasons that they do, Jonah, is because folks can be passive.
Yep.
They can pass the buck to a third party, and they know that over time in the 20th century, the numbers escalated so well over time that they think in the long run, I'll be safe, no matter what the current situation is. Well, we have a couple of thoughts to that. And of course, some of those thoughts are control.
Yeah.
We talked about that.
So here's the key. If that is you and you're out there doing the stocks and you like that, we not only recommend that you diversify. So we're talking about stocks and bonds and cash equivalent. We've talked about the categories, but we also recommend that you diversify within each asset class.
Oh,
so specifically
right.
for stocks here, we're talking about investing across various sectors. I'm talking company sizes. We've got large cap and mid cap and small cap companies.
U.S. companies, foreign companies.
Geographic regions, exactly. So West Coast, East Coast, in the United States, not in the United States. You've got to mitigate this sector-specific risks. And so here's the key, right? This is a finance podcast. We're the Banking Bros. We're talking about diversification. And for me, when I hear podcast episodes like this and somebody says, if you want to get in stocks, listen, you've got to pay attention. 1, you got to pay attention. 2, you need to large cap, mid cap, small cap, diversify. You need to get some inside the U.S., some outside the U.S. A lot of times for me, that's enough to go, oh, I'm not committed that much to figure all that out. And that's a lot of what I am personally. 1, I don't like riding the wave. And 2, I'm not committed to go do the research in this particular asset class to figure out how I can have a diverse stock portfolio. Again, diverse inside of the one asset class stock portfolio, so I don't ride these crazy waves. And for me, it's just too much.
Yeah, you and I are similar on this. We're not similar in every way. For all of you who are watching here at the Banking Bros, we have the same opinions about several things, but we're not the same person at all. And similar to you, I agree that my personality cannot handle the idea of losing and checking on it. If I'm going down, I don't want to know. I cannot be a day trader.
Sure.
I understand that. My mind is going to get fixated on some things. We do have a coach who is a day trader.
Yep.
For those of you who know Robert at the Cash Compound, Robert Lee, he is a day trader. He can talk about that. But my personality and some of my time cannot be used up being involved in that day-to-day. Now, most people are actually holding stocks long-term, right? They're holding stocks inside of mutual fund style portfolios as well as 401ks. So they are doing it for the long haul, which might be 30, 40 years. In their corporate plan from their job. But it's just normally not for me. Now, there are some great, there in our lifetime, there have been some great opportunities. If you got into Facebook and you held it, I have a friend in Greenville, South Carolina, where we live, got into Facebook. Early days of the IPO, decided to buy. Well, I mean, things are going pretty well.
Yeah, for Facebook.
100%. As well as, as well as many other things. Whatever. It's a Pinterest deal. It's honestly, I know
Bitcoin
things that are just, like I just know things that are like super popular. That's how little I'm invested in some of these ideas. But there are some things that are fixed income as well. And our next category here is going to be bonds. Now, bonds start to get into the area that makes sense for us in those cash equivalents.
That's right.
Okay, so bonds, ladies and gentlemen, if you're not sure what bonds are, they are loans made to corporations or the government, and they'll pay interest on those over time.
I like interest.
Yeah,
That's
100%.
Big deal. I actually like bonds. So in the same article that I was reading last week that talked about the ups and the downs of the stock market, it also started talking about treasury bonds.
Yeah.
Because apparently treasury bonds got this humongous boost last week because of the rise and fall of the markets. Now, again, I don't know, and I'm not claiming to know all the intricate details of why in the world did treasury bonds take a big jump, but I did jump over to the government website where you can purchase the treasury bonds here right now.
All right, let's take a look.
It looks like we've got a couple options. We've got a 20-year bond and a 30-year bond, and they're at about 4 and
4.7 and 4.6.
Yeah, exactly.
Just over 4.5.
That's exactly right. So 4.7 and 4.6 is where they are right now, and I think that's pretty good for a treasury bond, according to what I've seen in the last couple months, in the last couple years.
For sure. So what you're doing here is in full faith and trust and credit of the U.S. government or large corporations, you get into the game and they pay you interest. It's a loan to them, and they're paying you back.
Yep.
Now, why that's important is because we're going to immediately go over to cash and cash equivalents. Not because this is the quintessential category, but bonds and the cash equivalents go together inside the save and spend system.
That's right.
The save and spend system is based on utilizing whole life insurance contracts. Now, these are contracts. Let's get into that right quick. Once again, every time, Jonah, that I am doing a free cash consultation for somebody, including this week, I'm reminded that many people have not heard of us, have not seen us, and are new to this. So help us understand, when we talk about utilizing insurance, why is the word contract important to remember for most people?
Yeah, it's the reason because the other financial avenues that we have out there currently are not contracts. That's not how the terminology is. That's not how they work. So inside of insurance, it's actually what's even more technical, more granular, one level deeper. It's called a unilateral contract. Which what that means is that if you keep up your end of the bargain, whatever your end of the bargain is, the other party must keep up their end of the bargain. And that's a really big deal. What that means is you have a contractual guarantee. What that means is you've got an established agreement that will hold up in the court of law, that sort of thing, right? And so, and insurance, your end of the bargain, most of the time, is that you pay the premium.
Well, the right it's called unilateral is because basically they say if you pay those premiums, that's all you have to do.
And we'll do the rest.
Yeah, and that's nothing. You just give us the premium. We have to take care of the other 100 pages in your phone contract, in your car insurance, or in life insurance. And, of course, there is an inevitable ending to life, death. And so the reason we kind of put these two together is we want you to remember, or maybe for the first time, be enlightened to understand that mutual life insurance companies, the reason that they're able to provide large death benefits, you write a little check today, they write a big check tomorrow, is because they have established massive blocks of investment into government and corporate bonds for the long haul.
That's right.
So it's a guaranteed contract to you because they know they can do a little bit better and stay in business, but they can offer you that guaranteed contract, which in whole life insurance in North America has held up for over 200 years.
Yeah, the cool thing about what you just said is these insurance companies have invested in corporate and government bonds. So even in that one asset class, they're now diversifying with not just a corporate bond or not just a government bond, but they're doing more than one. So again, as we talk about diversifying your investment portfolio, we're talking about over all the asset classes. Even if there is one or two asset classes you really, really like, you've still got to diversify inside of there, right? And that's really important.
I think so.
So, yeah, I agree. Treasury bonds or other treasury bonds are like the government bond. There's also corporate bonds you can go get. We talked specifically
savings bonds. You guys remember those?
The treasury bonds.
Yeah.
But that particular asset class is a popular one. It's a treasury bond is a savings vehicle. It's a contract that says, listen, if you give us whatever you're going to give us and you're going to do it for 20 years, there's a guarantee that you're going to get this payout on the other side. It's not actually an investment per se, that particular asset class, not an investment. That is a savings attribute. So I really like those. There's nothing wrong with them. The only reason that I don't personally participate in treasury bonds is because you have to lock the money in there for 20 or 30 years to get the return. And I think that I can be more productive with my dollars without locking them up. I think I can go find some other things in our next category, like cash or cash equivalents, or the last one we want to talk about, alternative investments, that can produce just as well, if not better, because I've got used to the money, it's liquid, I can keep doing it or something like that, than I can do in the treasury bond. If I did not have any of those opportunities at all, then I'd probably take a closer and harder look into treasury bonds, honestly. Is there a good option?
Indeed. So cash and cash equivalents, this is pretty easy. And of course, when your dollars are liquid and they're in a third-party regular commercial bank account, or heck, you got them underneath the mattress, you've got liquid cash.
Yep.
And so that is an asset class that loses value because of inflation, right? And those dollars become less powerful in the marketplace, but they're liquid. Yep. You can use them. You can trade them for goods and services right here, right now, and stay protected in the world of control. Third-party control over those dollars is not what you're worried about when you got liquid cash.
That's right.
Obviously.
So in that category, there's savings accounts, there's mutual funds, high yield savings accounts are getting a lot of shine lately. We've talked about that before. You can do ETFs, you can do CDs. There's all sorts of things you can do in that category. That to me is probably the most widely known and how to access and people understand category. I think it's probably the easiest, cash and cash equivalents. And it's because those things are marketed to us actually a lot. So again, you've heard of high yield savings accounts. I mean, you're going to see them on the commercial, right? So that one's a pretty easy category. I don't know how in depth you want to go on that one, or you want to.
I think people kind of get that one.
Yeah. Let's move on to the last one, right? Which is the alternative investments. So now, this is a fun one.
Yeah. So this is one. What I would say here is basically this is commodities. These are things that I don't know how to define commodity exactly, but when you talk. But I'll give you the example. The quintessential example is going to be real estate.
Yep.
So what we've got is things that they have intrinsic value. People need to use them. Everyone trades money for it. You need it to survive. So when you're talking about lumber, you're talking about beef, commodities, things that have to move around in the marketplace. And if you're invested in those things, then that is an asset class that always has some sort of certain value.
Yep.
I don't know anything about lumber and beef.
The one that most people talk about when they're talking about diversifying your investment portfolio and they're going to mention a commodity is they're going to talk about gold or silver.
Sure.
Right? That's the big one.
It has intrinsic value no matter where you are, no matter when you are.
We've specifically talked about this in a few episodes back here, and I really don't understand gold or silver super well. Because when I hear, our podcast episode today is about an investment strategy. My idea of an investment in my head, somewhere back there, is to try something, go after something with the potential to increase in dollars. You got to understand that investment's going to imply some risk, but potential to increase. And once it does increase, to trade it in for the currency. That's my idea of an investment. And people who invest in gold and silver, most of them, it seems, have no intention of trading it in. And I don't understand. And I just don't
Those
get
people are ready for the sky to fall.
Well, there's a significant amount of them.
Yeah.
They buy gold and silver. So here's the crazy part.
But when they're right, they're going to be right.
I agree. But here's the crazy part. So gold and silver is fun. I've done a little bit of research on gold and silver. I looked up, did I read a book? I don't know. Maybe I read an article or listened to a few podcasts, right? So I've realized that gold and silver are on the upswing. They've actually, I think, always been on the upswing. In the last 10 years or so, gold has gone from, an $1,800 spot price to a $3,200 spot price. So what that's basically saying is an ounce of gold is going to cost you $3,200 right now. There's silver. Silver's always behind gold as far as the cost, and it lags. So if gold jumps this month, silver will jump in like 6 months. Silver's like on a 6-month lag behind gold. It's always been like that. An ounce of silver is not $3,200. It's literally like $108 or something right now. So everybody everyone's actually saying currently, go buy silver. Silver hasn't done the jump that gold did 3 months ago yet. So everyone's saying go buy silver. But here's the thing. It's I guess I could look up the spot price. I don't exactly remember what it is right this second for an ounce of silver. But it's like going to go so if it follows the trend, it's going to go from 108 to 127.
Just buy a lot of it.
And I'm like,
if you know it's jumping, there's nothing wrong with that.
Yeah, but I'm like, how are we spending $100,000 on silver?
Some people are.
Yeah. I guess.
Yeah, 100% because they know it's going to jump.
But then I'm going to sell it. That's what I'm saying. If I do all that, I'm going to sell it.
Okay, if you want to reach out and talk to Jonah specifically about your gold and silver ideas,
I'm just saying.
You need to get on our calendar. So remember that Cash Compound is full of coaches just like us who practice the save and spend system, and we help you understand how you can diversify your portfolio with the starting line in mind. And that starting line is to get the proper foundation set so you can go take the risks in the areas that you understand. And if that is gold and silver and precious metals, then we encourage it. But you're going to have to teach Jonah a few things when you talk to him.
You might. So I was actually off on that silver spot price. Spot price right now for silver
as of today,
$32. Gold, I was on gold, $3,200 for gold. And silver's at $32.
So yes, 100% traders, Jonah, reminder, they'll buy it now and they'll sell it at 35 because they buy a lot of it and money went up. Or they'll sell it at 40, 45, whatever. I don't know how far it's going to jump.
Did you know that when you sell gold and silver, it's not income tax, capital gains. It's capital gains tax for selling gold and silver.
I did not know that one.
Yeah. I told you I listened to a couple podcasts and did things. But in the alternative investment category, the alternative investment that we tend to talk about most and that we actually do ourselves is real estate. Real estate's the one that we like. Gold and silver is something that, again, I've been researching, but I have not stepped into just yet. I have not dipped my toes into that just yet, but real estate I certainly have. So we've done, there's all sorts of things you can do in real estate, but the one that we tend to do the most is private lending, actually. And we've done a significant amount of that. So if you don't know what that is generally a real estate professional that is interested in doing their real estate thing, whatever it is they do, whether it's refinancing and flipping and BRRRR method and all sorts of fun stuff, whatever they do, and they need dollars in order to do that for whatever reason. It could be because this is their 10th one of the year and the bank's not, entertaining them anymore because they've just been in the bank too many times or they got too much leverage out or whatever. And it could be because they've realized after doing one or two with private money that it's just easier for them. It's a couple pieces of paper and a friendly network, right? And they want to keep going that direction. Could be whatever. But private lending is you're going to lend the money to this person in the real estate space who is then going to do their real estate thing, and they're then going to pay you back principal, interest, all that fun stuff when that real estate idea has come to fruition, when it's done, when the house is sold, when it's flipped, when they've made their profit, they're going to pay you back. So the cool thing about this one is that it is private. It's that word, private lending, but also is that you can do all sorts of variable type of agreements. So big interest, little interest, short term, 1 month, 3 months, 6 months, 1 year, longer, 5 years, big stuff. Get in on a resort, right? There's lots of,
which is in our future.
Yeah, get in on a resort that's being built, or just flip the house next door to you with the neighbor, right? You can do whatever you'd like in this area, and we've actually got a few partners that we can point you toward and help you in this area if private lending is your thing, or if that's what you want to give a shot at. So that's helpful too.
Jonah, up next, what we want to help people understand is that you need to get in the game of your what is your strategy? What is your mission here? And are you monitoring how things are going? And the reason this is important for many people who we've realized like to listen to us is they aren't actually paying close attention to what it is that they want to happen in the end. We just got done reading and reminiscing on 7 habits in our office. And begin with the end in mind is one of the quintessential 7 habits. You guys know it. Stephen Covey, go ahead and get the book and listen and read it again. And beginning with the end in mind is a thought process in going, when this is complete or done or finished or grown up in the future, what is it supposed to be doing for me? How is it going to enhance my life and the people around me? Very important. So on that note, when we talk about diversification, what we are saying is check in. Monitor what you've got going on. Look back and try to figure out, is my portfolio, where I keep my dollars, how I have my capital invested? Is this the type of job and way I want to spend my money?
Yep.
I'm the biggest asset because I'm the one who has to spend all the time. I'm the one who can create the opportunity. I am the capitalist. What is it that I'm supposed to be producing in the marketplace? And am I producing money or capital in a way where, number one, I am fulfilled? You want to be there. And number two, is my money working, or is it in places that are convenient and can be transactional, can move into the areas that I'm actually interested in? So check on your portfolio. And yes, this does trickle down into things like dollar cost averaging. If you're looking into your actual retirement portfolio and trying to figure out how things are going. If the market dips like it did at the 1st of April, 2025, how are you going to reallocate? Are you going to reallocate? Are you going to get out? Or are you going to stay in? All of those things are important, but you need to actually spend time figuring out what is the best strategy for you, in our opinion, for code cracking cash flow. No matter what you're doing, your dollars need to be in a place and space where they are able to be controlled by you for the best opportunities that you can find for the long term. And you need income when it comes down to it. So That's what we want to remind you of on this particular episode. Jonah, give a shout to who's following us this week.
Yeah, big shout out this week specifically to Thomas Varghese. He is a YouTube subscriber over there. So what that means is he hit the subscribe button on our channel, maybe under one of our videos. And hopefully he also hit that notification bell, which is going to let people know, let Thomas know, let you know that we've posted a new video over there. So we've got a couple of videos going out every single week where we talk about the general finance topics, or we talk about the infinite banking concept, one of the places in that cash and cash equivalent that we would recommend that you diversify into once you've learned about it, which we're happy to have a conversation about. But Thomas, thanks so much for subscribing to our channel. If you leave a comment on a video, or we will make sure we get to it. We'll make sure we answer it, and that way we can keep you engaged and make sure that we're answering your questions where you are. So we appreciate you, and hopefully we'll chat with you soon, man.
That ends our episode on the Banking Bros podcast here, helping you understand what diversification is all about, how you can get involved in those things, and what asset classes, most importantly, there are. You can get into business for yourself. That's an alternative investment, or you could invest in someone else's. That's stocks. Whatever you want to do, just make sure you understand what is right for your personality, right for your habits, right for your cash flow needs in the long term. And we think that you should start at the foundational tool, utilizing infinite banking concept for the ability to take risk wherever is best suited for you.
You are now tuned to the Banking Bros. Said we couldn't make it, drink or settle, this the life we chose. Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.
And that wraps up today's episode of the Banking Bros podcast. We hope you now have a better understanding of how to build a diversified portfolio that works for your financial goals. So remember, it's not just about eliminating risk, it's about managing it effectively. So keep learning, keep growing, and if you ever need guidance, we're here for you. So make sure that you stay tuned. Listen to more episodes. Stay tuned for our future episodes, because we're always talking about financial insights. Until next time, take control of your finance and start building your legacy. We'll see you.